Welcome to a Seek and Prosper interview from S&P Global. My name is Nathan Hunt. I'm joined today by Marian Amiot, who is the head of climate economics at S&P Global Ratings. Marian, welcome.
Thank you. It's nice to be here.
So, historically, climate change has always been sort of over the horizon for financial markets. What has changed? Has climate become material to creditworthiness?
So that's a very good question. I think I would say two things are true now. So yes, climate will increasingly be a problem, or more impactful, I should say, over the horizon. So we know from climate science that the risks are just increasing as long as we don't get to net zero. But it's also true that eventually we are catching up with the horizon. So we see that physical risks are much more impactful today. So I think last week in Florida, in the US, we had one of the most extreme, if not the most extreme storms we've ever seen, I guess. There is also in Europe a lot of evidence that new risks are coming up, like floods we've had this summer that didn't really appear to be a problem before. And then you can also think of droughts that are impacting consumers across the world. So if the food supply is affected by droughts in specific countries, you end up seeing it in the supermarket as a consumer. So I'm thinking specifically in Europe, for example, the Mediterranean's had droughts in the past few years, and you've seen in the UK that olive oil prices were higher. So I think increasingly we see the impacts coming through, and this impacts livelihood. So people die when those events happen. In Florida, for example, last week, we see that people lose their homes. So this might also impact insurance premiums going forward. So you kind of start to see all of these impacts adding up. Having said that, it's also true that depending on the sector or the country, you're not facing the same size or magnitude of impact. So it's not going to be necessarily material for everyone. And at the macro scale, unless you're a country in the Caribbean, it might not necessarily move the needle to say that physical risk defines the whole economy. So it is one growing issue, but it's not necessarily yet trumping the rest, I would say.
How do you approach your evaluation of transition and physical climate risks? How do you evaluate that?
So because there is still a lot of uncertainty around climate risk, so physical risk, we kind of know what it looks like, but still we can get surprised about the size of the events or where they actually happen. But we have a rough idea of what might be plausible going forward. And for transition risk, we're looking at mostly policy-driven change. So it's about what policymakers across the globe will decide to do about climate mitigation, but it's also how companies invest in new technologies and are able to deliver that really disruptive innovation to get to net zero. And as well, how consumers decide to change their mindsets or how they view the risk and how they want to consume accordingly, I guess. So there's a lot of uncertainty and a lot of moving parts in what climate change or the transition to net zero could look like. So you can't really forecast, I would say, those type of risks. So the best way to go about it, and it's not just us in ratings, but central banks and regulators do the same, is to think about it in terms of scenarios. So you will pick a few narratives that might make sense. And this really helps you understand what are the drivers of physical and transition risk. When you kind of map out the narrative, you also see where the pressure points appear. So when you think about the transition, for example, a typical policy move you could imagine in the models at least is a country putting a higher carbon price. So this could be quite material for an industry that is emitting a lot of carbon, right? So this helps you kind of assess, okay, where are the costs, where are the potential revenue streams? So the transition also creates opportunities for some companies. So we see it, for example, in the auto car market, electric vehicles are taking a much larger share of the market. So you kind of, by going through the scenarios, you kind of see the drivers, the transmission channels, and how this might play out for different companies, different sectors, and different countries. And this enables us to map a little bit where the risk lies, which countries or companies are the leaders, the laggards. And so depending on what actually unfolds, you kind of know, okay, this is where the range of potential outcome is for the different sectors, and this is how it could play out for credit materiality. So it's not necessarily direct, but you can still think through the process, I would say.
You recently wrote an article where you looked at the impacts on credit of various scenarios. And in that scenario analysis, you looked at sort of three big categories. One was, in a sense, global discord. Another was green rules, where the goals of the Paris Accords are actually actively pursued. And you sort of had a middle sort of inflection point type of scenario. How would geopolitics affect how you would look at those scenarios going forward?
So I should say first, these are scenarios developed by S&P Global Market Intelligence. So it's part of S&P Global, but not within ratings. And yeah, I think the narratives behind those three scenarios are kind of a best case scenario. It's like green rules. We get really good at designing all of these new products that get us to net zero. Everybody, or like all countries, really make more efforts to get there. And so we get this transition relatively quickly. Then there's inflection, which is more a status quo scenario, I would say. So we just carry on as we've done so far. So we've done quite a bit of progress in the past few years. So it's not too bad, but it's not the best case for climate change. And then there is discord, as you pointed out, which is more centered around the geopolitical risk, I would say. So in these scenarios, countries don't really cooperate to get to net zero. So how this may play out is that maybe investments are more localized, the supply chains are more fragmented, technology transfers might not happen across countries. So obviously in the model, it's always, you drive these results through assumptions, and it's not necessarily very clear, but I think in the narrative, it comes out quite well. So you would just get slower progress to get to net zero if countries don't cooperate globally. And I think to a certain extent, we see that risk today, right? When we have trade tariffs put on electric vehicles, solar panels, etc., this will likely slow the transition to net zero. So again, it's a plausible outcome, even if it's not the best case for the planet.
Marion, thank you so much for joining me today.
Yeah, thank you. It was great discussing this topic.
This has been a Seek and Prosper interview from S&P Global. Please look out for the other interviews in this series. Thank you.